Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Marketfy. I'm your co-host, Joel Elconin, along with Brianna Valeski. And we have a market veteran on the line. That's Tim Melvin, Marketfy Maven, and the author of the Tim Melvin Deep Value Letter. Tim, how you doing on this Friday?
Well, I'm doing great, except of course we're in mourning for my Baltimore Orioles.
Yeah,
We've
what's going
managed
on?
to.
Did you guys go under the tank there a little bit?
Wow, I don't. We went from contending to the title to being just completely out of it. We lost 12 out of 13 games. So
Yeah,
I,
well,
I got.
I'll give you a shoulder to cry on here with our Detroit Tigers, the same kind of thing. But
Yep.
and Tim, moving on to the markets here, and you're the author of the Deep Value Ladder, looking for good investments in the banking sector, and I know you've nailed a few on our show. Before we go to that, Dennis and I had a long talk at the beginning of the show. We were talking about the banks and how the financials on days like this can kind of have a little bit of mind of their own. In other words, if interest rates are going up, that's perceived a little bit better for the banking sector. Could you make a comment on that?
I mean, most of what I do is down in the really small banks, and they ignore the market as a rule. But yeah, if there's a perception that rates are going to go up, that could bring a little bit of buying, even on a day like this, into some of the financials because higher rates are just fantastic news for banks.
You think that's where we're going? At least in
I,
September?
You know what? The worst job in America is the head of the Fed right now because the data doesn't support an increase, but they want an increase, and it just I have no idea. Okay, I don't
Yeah,
think the economic data justifies an increase, but they seem hell bent on doing it.
yeah, that sure does. It sure seems like that. So just comments here. The big banks. I know you're generally, you like to focus on the small ones here. I mean, if you had to buy a big bank, well, what? First of all, where do you put your money? What bank do you use, or do you have so much you have to use a bunch of different banks?
Actually, my wife was a banker for most of her career, so some of our accounts are at Wells Fargo, and then I still have accounts at a little bank in Annapolis.
Okay. All right. So there's Wells Fargo. All right. Let's move on to some issues that you have on your radar. Then we'll review a few from prior shows. And the first one here, I don't know the name of it. CLNY. What's the story with that issue?
All right, this is Colony Capital. This is a REIT, and earlier this year, uh, they basically merged with their management company. They were called Colony Finance. Colony Capital was kind of a hedge fundish real estate operation. Well, they merged the two together. So now you're not just getting this simple little REIT that owns a few triple net properties and makes some loans. Okay, you've now got this massive real estate firm that has a 62% interest along with its some partners in 315 light industrial properties all over the United States, red hot segment of the market. There's not enough small warehouse space out there. Got a whole portfolio of triple net lease properties, most of which are in the medical property area. They invest and originate real estate debt. They have a specialty in distressed real estate debt. They have a big real estate investment management firm that generates fees off $18.7 billion in assets. Sitting here trading a little bit above book value, but I really think that book value is understated. And I left out here they have a 23% interest in Colony American Homes, which is 19,000 single-family homes bought near the bottom of the market. So I think that the value of these properties is probably a little understated on the book. You're getting a 6.9% dividend yield that should go up over time, and you just have this
Wow.
fantastic collection of assets.
Wow.
So yeah,
Yeah.
it's just great commercial property, long-term investment, and it's one of these things I think you can buy. Market goes down, you buy a little bit more because you can own this for the rest of your life.
Tim, this is a heavy volume stock for you here.
Oh, we're dealing in volume today. I'm telling you.
No, I mean, I traded half a million yesterday, 750 yesterday. I mean, I'll get dirty in this one. I mean, no problem. I'm not sure how big the spread is, but that's decent
That's
liquidity.
yeah. There's not much of a spread in this, and it's
No, no. And you know what also
well,
I like about it, Tim? And sometimes with the charts with some of the issues you bring up, it's a little bit hard. But I really got a good feel on the technicals on this one. I mean, you could draw a steep trend line coming off the triple top at 23. It comes down, it touches these highs. It actually probably hit the high of it yesterday. So if you're
mhm.
looking to buy this in a little bit of strength, maybe bump, a couple closes above 22, and then the support's been moving up since that panic day when we hit 2077. So I really like the chart in this one, and 6.9% dividend. I could see Dennis putting his buy order in right now on this one.
Yeah, this is like I said, it's a great collection of assets. The people that run in it, they're experienced. They've been around a while.
What
They
does
know
it
the
the
game.
street like? What does it the street like about it though, Tim?
Yeah, it's complex. Okay, and you're going to see this in my next idea too. There's a bunch of partnerships, and they're co-investing on a bunch of stuff. The merger transaction was unusual to say the least in the way it was structured. You don't usually have this, kind of REIT folding into a hedge
Okay.
fund and then coming out with the name of the hedge fund. Um, so it's just, it's not in the indexes, it's not in the
Not
ETFs. That's
sexy.
where that's all the money's been in real estate. Okay, real estate's been this massive yield-seeking asset allocation trade, and it's drifted towards the great big REITs and the ones that are in the indexes and the ETFs. So they're hopelessly overvalued. But then you come down and you pick around the smaller stuff, and there's some real value out here.
Okay. Another property REIT, Brookfield Property Partners. What are they into? Are they into nursing homes or are they into something different?
No, look, they own the skyline of major cities around the United States, and again, it's complex because a lot of this is done through partnerships with Brookfield and with outside investors. But they own 260 world-class office properties around the world. I'm talking things like One Liberty Plaza in New York, One New York Plaza. All the West Side development is them. The Allen Center in Houston. They're 6%. Sorry, 20-some% owner of Canary Wharf in London, that huge residential retail office complex that's there. They own 440 auto dealerships just here in the United States on a sale leaseback triple net basis. Then they were involved in the restructuring of General Growth Properties when that big mall REIT went bust a few years ago.
Yep, I remember that.
So they walked out with 29% ownership of General Growth Properties and 34% ownership of Rouse Properties. They have an interest in 28,000 multifamily units here in the United States, 44 million square feet of that light industrial property we were talking about, and they have 12 hotels and resorts, and they're all world-class hotels that you would recognize and know.
What about Kearney Financial Corp here? First, tell me what happened. Boy, it had one bad day here back
Now,
in May.
no, Tim. Let me backfill one thing on Brookfield real
Okay,
quick.
sure, go ahead.
That management did their conference call a few weeks back. They published an estimate of unit holder value. Their estimate is $30.19 a share. It's trading at 20.
Buy it. Okay.
Okay, with a 5% yield. Now, Kearney Financial, what you're seeing in that chart there, they did a second step conversion. They were
Okay.
owned by a mutual holding company, and what you're seeing is just a share ratio exchange. That's all.
Okay.
It never actually traded there. Just nobody ever really adjusted the chart for the share distribution.
Dividend on this one.
Minuscule. They just initiated their very first dividend. Post conversion, it works out to about a 0.97, but that's going to grow really fast. These guys raised a ton of capital in the offering. So you can look for that dividend to go up year by year by year. It's just a nice little mutual thrift. So they've got a ton of capital. The equity ratios are kind of off the charts. Very, very low loan loss ratio.
Book
sitting there
value.
in
What's the book value?
the book value on this, we're now trading at about 88% of book value. You got a hard book of about $13.15 here.
Okay, that's one to keep an eye on here. We got another one, ISBC. Tell us about that issue.
Oh, listen, I love this one, and it's one of the ones that's right there on the list. When I see the market's down, it's one of the first quotes I check. This is the largest thrift conversion in history. Investors Bancorp did their thrift conversion offering, immediately turned around, used the money to buy Roma Financial. Now, the stock's trading a little bit rich at 1.1 times book value, but they've got a brilliant CEO, Kevin Cummings, running this thing. They're going to grow by acquisition. I think they've done 8 deals since 2010, all other thrifts, of course. But these guys are going to see every deal on the East Coast. The bankers know they have cash. They know they want to grow. So every bank that comes up, they're going to make a call over there to Short Hills and say, "Hey, do you guys want this one?" So they're going to be able to cherry pick some bank deals. And I think you'll see this grow at a very high rate over the next 10 years at least. So 1.1 times book, I'm not quite ready to buy it, but it doesn't have to come down far because it's just such a quality bank.
Okay, and the final one is BND. Is that a New York stock there?
B&B, I think I know it's BNCL, Beneficial
Oh, I'm bad. Okay,
Bancorp. That's a
BNC.
Philadelphia Bancorp. And
Okay.
again, it's another second step thrift conversion. They're awash in cash as a result of the offering. Minuscule loan losses, bunch of smart, smart money in there like EJF Capital, Lawrence Seidman's in there, a couple of other activists. Arbiter Partners, one of the smarter hedge funds in the country, owns the stock. Um, Philadelphia is an incredibly crowded banking market. So these guys are basically looking at, I think, over the next couple of years, buy or die scenario.
Mm-hmm.
They're going to have to buy somebody else, or somebody's going to buy them, and you can't rule out them buying somebody else, and then the whole mess getting bought by somebody, because mergers have lagged in the northeast part of the country. That's going to change. The regulatory costs are, they're getting worse, not better, and now you're adding in the cost of upgrading your IT, your technology spending. So it's difficult for these, small to mid-sized banks to really make money. So you've got a buy or die scenario. Either one works out, makes us a ton of money in this stock.
Sorry, I was a little bit slow on the symbol there. That's BNCL. There's the chart, little consolidation. All right, Tim, I'm kind of kicking myself here because I asked you about Monroe Bank and Trust, and you brought it up on the show randomly, and I think it's moved up from 6 to almost 650 here. Is there still value in this issue?
Yeah. Yeah, there is. Let me just get MBT Financial. We're trading here
Wow, 650.
just a
Yeah.
just a hair over book value, and we've been in this for over a year, so we're down. We own it down in the fours.
Good.
But it's an attractive bank. Once they sold off in 2014 that package of bad loans that they had on the books, this became this awesome, clean little bank right there. In Monroe County, your hometown, of course.
Yep.
And so, if anybody looking at the Detroit market, and Detroit's still not pretty, but it's not as ugly as it used to be financially speaking, and there's signs that the city's coming back. So, if you're a larger bank and you're looking and you're thinking maybe I should get into that Detroit market, this is not a bad candidate to consider. And there are some activists in the stock
Mentioned
that
that.
are kind of leaning on management a little bit to make that happen.
Yep, you did mention that. So when we have people on the show, they talk about the trade of the day or the trade of the week or the trade of the month. But Ethan wants you to talk about the trade of the decade.
Well, the trade of the decades, it's what I talk about every time I come on this show. It's the small banks, okay? You've got all these small banks in the United States, and the number's been going down every year since something like 1987, okay? But the pace is accelerating of this major bank consolidation. These are the banks that survived the credit crisis. If you remember, in 2009 and 10, the FDIC was just closing down and disposing of the assets of a bunch of these little banks. These are the survivors. They're the tough guys. But they may be tough, but they're not big enough to survive because, as Congress always does, they passed a whole bunch of rules after the credit crisis, and they applied them to everybody. So Monroe Bank and Trust, sitting here with a market cap of all of $144 million, has to obey the same rules that Citi or Bank of America does. So the big banks, they say, all right, add 15 lawyers, that takes care of it. Monroe MBT Financial looks at it and says, okay, we got to hire 2 more lawyers. This is a disaster, okay, because it really eats into the bottom line of the bank. Then you've got technology costs coming up. Cybersecurity is huge there. I go in a bank branch from time to time, but my kids, probably haven't been in one since they opened their accounts because consumers want that mobile banking experience, and it has to be top notch. Excuse me. So it's all this money they have to spend. It's basically they need to find a merger partner. Then you look at the slightly bigger banks, they say $1 billion and over in assets, and they have a whole different set of problems. There's no growth in the economy to speak of. And although the number of banks has declined, the number of branches has not. Drive down the street from your office and you'll notice on every corner there's a McDonald's and a bank.
Okay. All right.
So there's plenty of bank branches. So you're not going to open branches and have de novo growth anymore. The new path to growth is acquisition. So you got a bunch of banks that have to sell, and you got a bunch of banks that want to buy. So now we just got to argue about price.
All right, Tim, what about, all right, so you mentioned a lot of these individual stocks, and some of them are, you definitely mentioned some ones that had some good liquidity today. Is there a way to play this? Now, I'm looking at the KRE, and that's the Regional Bank Select Industry Index. Do you go, I mean, is that something that you would say, okay, I don't want to try and pick the individual banks, but I think the sector's going. The chart had the big sell off,
Yep.
and actually it's been moving up very steadily since the
No,
financial crisis. Is that a way to play this trend, the trade of the decade?
absolutely not.
Okay, go
And
ahead.
nor is the QABA
Okay.
Community Bank Index. This is a rifle game, not a shotgun game. You've got to really target your individual banks because you want to be buying at a very precise level.
All right, that's a great answer. I mean, that's exactly. I know Dennis would agree with that on some of the ETFs. So you just got to do your homework, right, Tim?
Right, and if you don't want to do the individual banks, and then I want you to get out a piece of paper and do the Bart Simpson thing, and write 100 times, "I don't like money."
Okay. All right.
Okay, because this is not a maybe it's going to happen. Gee, that sounds really great. Hyping the story. Google bank consolidation. I sent out a thing this morning. It was the fifth time I've done it this year, called Compelling Evidence. Just collecting articles from journalists and hedge fund managers and other folks and bankers talking about exactly what's happening in this sector. This is getting started. It's going to happen. If you buy these things at 85% or so book value, which is where we've been able to buy a lot of them, there's 30 stocks on my buy list this week. You're
That's a
almost
lot
just
for you,
you're,
Tim. That's a lot for you. Remember when we were
yeah.
last time we had you on? Well, how did I mean? We always like I
Well,
usually lead the
that's in
show with
that's
that.
in that's in the banks, Joel. It's in the broad market. We're still not finding a lot to buy, but just small banks specifically, we have 30 banks to buy right now.
But that's up from when the last time. You do your
It was
super.
21, yeah.
Yeah, so that's up for then. So that's good. I mean, but just still your overall scan on the market, that's still kind of looking a little barren, huh?
Yeah, I mean, in this recent little goofy doofy, we bought a couple things, but not much. We bought a closed-end fund that owns energy stocks at a discount, kind of getting the double whammy there on the cheap side. And I've got an order keyed up this morning for one stock,
Okay, what's
uh,
that?
Unisys. How's that for some liquidity from me, huh?
What's the symbol?
UIS.
U- Unisys.
Unisys. Now, check this out. When this hit my screen, it's got an enterprise value to EBIT measure of 5, which is one of my valuation tools. It's 5.6 times. It's very low. But I looked at it and I said, Unisys? I don't want to own Unisys. This is a garbage old tech company. And
Yeah, I
they're
know.
behind. And okay, now I start digging. And I get into the financials and I make a few phone calls to some guys that I see on the stock that I happen to know. They've got a new CEO in. Okay, and this is the guy that turned around and sold Perot Systems, and he did
Wow.
one other big takeover deal. Now he's been in there. He's announced a restructuring program. Which when they came in, management said, "Look, there's a lot of stuff we need to do and some charges we need to take," but nobody was willing to charge him to take the charges. But you're new, so you can get away with this. So
I see
he
a
did. He took a
yeah.
$300 million charge, but this is going to save $200 million a year straight to the bottom line. Now, by 2016, they'll be doing the full 200 million a year run rate, which means in 2017, never mind what they make operationally, the cost savings is going to be $4 a
Enormous.
share bottom line.
Well, thanks for stepping out of your sector there a little bit and giving us another stock. Tim, I know we've kept you on a lot. I just got one more question for you. You're a market veteran. What was going through your mind last Monday?
Uh, you know, Nothing. Is anything cheap? Has anything gotten cheap enough to buy? I said we did put some orders in. We bought some stuff. Um, but keep in mind, market volatility has really jumped up in the last month. But you know what has not happened? The market's not cheap. We can argue all day, is it full or fairly valued? But it's not cheap. This is still at 19 times trailing earnings.
Okay. All
So
right.
we looked for what was cheap. We saw a couple things. We bought it, but we're not overly excited about the decline. It wasn't a major buying opportunity in my eyes.
Okay, Tim Melvin, Marketfy Maven, and the author of the Tim Melvin Deep Value Letter. Always giving us some great issues to take a look at. We'll keep an eye on these, Tim, and we'll talk to you again soon.
All right. Thanks a lot, guys.